Listen, I need you to stop whatever you're doing right now. Put down that newspaper. Pause that television show. Tell whoever's talking to you that you'll be back in 20 minutes, because it's Tuesday, January 21st, 2026, and what I'm about to show you is something I've only witnessed twice in my entire career analyzing precious metals markets, and I've been doing this longer than I care to admit because admitting it would require acknowledging how many gray hairs I've earned watching these charts. Silver is currently trading at approximately $96 per ounce. Gold just crossed $4,950 and is within striking distance of 5,000, which is a number so big it sounds like something from a science fiction novel. And if you don't understand what's happening right now, if you don't see the pattern that's forming on these charts like storm clouds gathering before a hurricane, you are about to miss one of the most explosive moves in commodity market history. Not might miss, will miss, because what's coming doesn't wait for people to catch up. I'm William Lee, and I need your complete, undivided attention for the next several minutes. Turn off the distractions, close the browser tabs, ignore the email notifications. Because what I'm going to walk you through is not speculation. It's not hopium, which is what the kids on the internet call wishful thinking. It's not me pumping my own position because I bought silver at $80 and desperately need it to go higher so I can sleep at night. What I'm going to show you is a technical setup, a specific pattern on the charts that has appeared exactly 3 times in the last 50 years in silver markets. And every single time this pattern has completed itself, every single time it's run its course, the subsequent move has been so violent, so fast, and so extreme that people who weren't paying attention literally could not believe the charts were real. They thought there was an error. They thought the data feed was broken. They called their brokers to complain that surely the numbers must be wrong. 3 days ago, on January 14th, 2026, something appeared on the silver chart that made me stop what I was doing, which at that moment was probably checking whether I'd remembered to take my vitamins, and stare at my screen for a solid 30 seconds without blinking, a single candlestick. Now, if you're not familiar with candlestick charts, don't worry, I'm going to explain this in terms that actually make sense instead of the incomprehensible jargon that financial analysts love to use to make themselves sound smart. A candlestick is just a visual representation of what happened to price during a specific time period, usually one day. The fat part, the body, shows you where price opened and where it closed. The thin lines sticking out the top and bottom, called wicks or shadows, show you the highest and lowest points price touched during that session. Simple enough, right? Your grandchildren probably understand this better than you do because they grew up with charts on their phones, but that's fine, we're all learning. What appeared on January 14th was a green candle. Green means price went up, red means it went down. So massive, so powerful, with trading volume so extreme that it erased weeks of back and forth sideways movement in a single trading session. This wasn't just a strong day where silver went up a couple dollars and everyone felt good. This wasn't just a breakout candle where price pushed through a resistance level and traders got excited. This was what people who've been in commodity markets for decades, people who've seen everything from oil shocks to gold rushes, call a God candle. And if you don't know what that means, if you've never heard that term before, then buckle up because I'm about to explain exactly why this single candle is potentially the launch signal for a move from $95 to $250 in the next 30 days. Now, before we go any further, I know exactly what some of you are thinking because I can practically hear it through the screen. $250 silver in 30 days? That's impossible. That's insane. That's a 160% move in 1 month. William, have you lost your mind? Did you forget to take your blood pressure medication? And you're absolutely right to be skeptical. Under normal market conditions, that kind of move would be impossible. It would violate every rule of how markets typically behave. It would be like your neighbor's house suddenly being worth 3 times what it was worth last month. It doesn't happen. But here's what you need to understand, and this is the critical point that separates people who make money in these situations from people who watch from the sidelines and regret it later. We are not in normal market conditions. We haven't been in normal conditions since the Greenland discovery was revealed, and the world realized there's 2 billion ounces of silver sitting under the ice. We haven't been normal since the tariff trap activated, and suddenly silver can't flow freely between New York and London anymore. We haven't been normal since the COMEX registered inventory, which is the actual physical silver available for delivery to people who demand it, dropped below 50 million ounces, while the paper claims on that silver number in the hundreds of millions. And we are definitely, absolutely not normal when gold is about to hit $5,000 per ounce. What we're in right now is called price discovery mode. And this is a term you need to understand because it explains why normal rules stop applying. Think of it like this. Imagine you're trying to buy a house in a neighborhood where no houses have sold in 5 years. The last sale was at $300,000, but now suddenly everyone wants to live in this neighborhood. Maybe they built a new school, maybe they put in a park, maybe some celebrity moved in, and now it's trendy. You make an offer at $310,000 thinking you're being generous. Rejected. You offer $325,000. Rejected. You offer $350,000. Someone else outbids you at $375,000. The price keeps climbing because nobody knows what the right price is anymore. There's no recent reference point. That's price discovery. The market is searching, sometimes frantically, for the new equilibrium. In price discovery mode, normal rules don't apply. Normal support and resistance levels, those price points where traders expect buying or selling pressure to show up, don't matter anymore because we're in territory where those levels don't exist. Normal technical indicators, those mathematical calculations that traders use to predict what might happen next, stop working reliably because they're based on historical patterns and we're now in uncharted territory. Because when a market enters true price discovery, when it breaks into a zone where there are no historical reference points, no overhead sellers sitting on positions waiting to take profit, no established equilibrium where supply and demand balance, the price doesn't climb politely like a well-behaved guest using the stairs. It explodes like someone lit a firecracker under it. Let me show you exactly what happened on January 14th, because most people looking at that candle, if they even bothered to look at it, which most didn't, don't understand what they're seeing. They see a big green bar on the chart and think, oh, nice rally day, silver went up, good for people who own silver. But that's not what this was. That's like looking at a tsunami warning and thinking, oh, there might be some big waves today, should be good for surfing. Let me break down the 3 specific characteristics that define a God candle, and then you'll understand why this is categorically different from a normal strong trading day. Characteristic number 1, the body of the candle, that fat part showing the range between opening and closing price, must dwarf the recent average by a factor of at least 3, preferably 5 or more. In other words, it needs to be so much bigger than the typical daily movement that it stands out on the chart like a skyscraper in a town of single-story buildings. On January 14th, silver opened near $78.42 and closed near $92.25. That's a move of $13.83 in a single session. One day, from morning to afternoon. That's like if your favorite stock that normally moves 50 cents a day suddenly moved $8. Now, to put that in context, the prior 20-day average trading range for silver, meaning the typical amount it moved in either direction on an average day, was approximately $2.64. So let's do the math together. And don't worry, I'll make it simple. Take $13.83, which is how much it moved on January 14th, and divide it by $2.64, which is how much it typically moves. You get 5.2. This candle was more than 5 times the size of the average recent candle. That's not just big. That's not just unusual. That's structural. That's the market telling you that something fundamental has changed in how silver is trading. Characteristic number 2, volume must explode to at least 300% of the recent baseline. And I'm not talking about volume being 10 or 20% above average, which happens all the time and means nothing. I'm talking about trading volume that is so extreme, so far beyond normal, that it indicates institutional players, hedge funds, sovereign wealth funds, pension funds, and major commercial entities are moving massive amounts of money simultaneously. This isn't Joe from accounting buying 100 ounces. This is billions of dollars changing hands. On January 14th, reported futures volume was approximately 947,000 contracts versus a recent 20-day average of around 223,000 contracts. That's 425% of normal volume. That's more than 4 times the typical daily activity. Each contract represents 5,000 ounces of silver, so we're talking about movements of billions of ounces worth of claims, even if most of them are just paper promises that will never result in actual metal changing hands. You don't get that kind of volume from retail traders on Reddit getting excited about a post. You don't get it from coin collectors buying a few tubes of silver eagles. That volume comes from entities that move hundreds of millions or billions of dollars at a time. That volume comes from players who are either absolutely terrified of being caught on the wrong side of the trade or extremely confident about massive upside coming, or both simultaneously. That volume tells you that the market's internal structure, the balance of power between buyers and sellers, is changing in real time. The old equilibrium is breaking. Characteristic number 3, the close must be near the top of the day's range with minimal upper wick, which in plain English means that buyers maintained control throughout the entire session and into the close without significant pushback from sellers. On January 14th, silver ran up to a high around $92.94 and closed at $92.25. That's a close within the top 2% of the session's range. There was almost no rejection at the highs. There was almost no selling pressure when price pushed to its peak. Just relentless, Persistent, determined buying that stayed in control from the opening bell all the way to the closing bell. When you combine those three characteristics, massive body that dwarfs recent candles, massive volume that's 4 times normal, and a close near the highs with minimal rejection, you get something that is statistically rare, like finding a 4-leaf clover rare, like winning a hand of poker with a royal flush rare. This type of candle appears maybe once every few years in commodity markets, and when it appears, it's not random noise. It's not market chaos, it's information. It's the market screaming at you, trying to tell you something important, that the previous structure, the previous equilibrium, the previous balance between supply and demand has broken. Something fundamental has changed, and if you don't pay attention, you're going to miss what happens next. Now here's where this gets really interesting, and this is the part that most analysts are completely missing because they're too busy looking at their fancy indicators and not paying attention to context. Silver has had strong days before. We've seen big green bars over the last decade. We've seen days where silver rallied 3 or 4% and everyone got excited, but most of those big green bars happened in markets where there was overhead resistance waiting like a ceiling, where there were sellers lined up at certain price levels ready to take profits, where the paper market, which is the futures and options market where most silver trading happens, could manufacture supply by issuing more contracts and creating more synthetic silver to meet demand without anyone ever touching actual physical metal. This God candle on January 14th printed in a completely different environment. It printed in a world where 3 critical conditions have aligned that make this setup unlike anything we've seen since 2011, and possibly since 1980, which for those of you old enough to remember was when silver went absolutely bonkers and hit $50 an ounce before crashing back down. Condition number 1, overhead resistance is essentially gone. Silver has pushed into all-time high territory. Now, for those of you who don't follow charts religiously like I do, which is probably a healthier way to live honestly, let me explain what that means. Overhead resistance is like a price ceiling where sellers show up. If silver tried to rally to $90 in 2023, there were people who bought at 85 and they'd sell at 90 to take their profit. If it tried to hit 95, there were people who bought at 90 who'd sell to lock in gains. These resistance levels act like speed bumps, slowing down rallies. But when price enters all-time high territory, those speed bumps disappear. There aren't sellers waiting at 97 because nobody bought at 95 to sell at 97 for a small profit. There aren't sellers at 102 because nobody has positions from 100 that they're trying to exit. The usual reference points that traders rely on have disappeared like landmarks in a fog. That means the market enters what we call discovery mode, which I explained earlier. And discovery mode is not calm. It's not orderly. It doesn't politely consolidate and give everyone a second chance to buy at better prices like a polite host offering seconds at dinner. Discovery mode is where gaps happen. It's where price jumps overnight from 96 to 104 without trading at any price in between, which means if you had an order to buy at 98, tough luck, you didn't get filled. It's where air pockets appear, which are zones on the chart where almost no trading occurred historically, so there's nothing to slow price down as it moves through. It's where the market runs so far ahead of expectations that people watching from the sidelines experience what I call chart disbelief. They look at the price and think, that number can't be real, there must be an error, let me refresh my browser. But it is real, and by the time they refresh 3 times and finally accept that yes, silver really is at $120, the price has moved another 20% higher to $144. Condition number 2, the seller side has thinned out dramatically, and this is critical to understanding why this move could be so extreme. When the majority of the open interest in the silver market, which means the total number of outstanding contracts, is held by entities that aren't trading for fun or trying to make a quick profit, when it's held by industrial users who actually need physical metal for manufacturing, by long-term strategic accumulators like sovereign wealth funds, by entities that are buying silver not as a trade but as a strategic position for the long haul, those entities don't behave like day traders or speculators. They don't dump their positions because some oscillator looks overbought, which is a technical term meaning the market has rallied too much too fast, according to mathematical formulas. They don't panic sell on a 3% pullback because they're worried about losing profits. They don't care about short-term technicals or chart patterns or what some analyst on CNBC says. They care about securing supply for their factories. They care about hedging against currency devaluation. They care about strategic positioning for the next decade. And when the market is dominated by those types of participants, selling pressure at any given price level becomes extremely thin. It's like trying to buy houses in a neighborhood where nobody wants to sell. Every house that does come on the market gets bid up immediately because buyers are desperate and sellers are scarce. That's why God candles often have tiny upper wicks. It's not because sellers tried to push price down and failed, it's because sellers barely showed up at all. Nobody is really offering significant size into the move because the entities holding large positions aren't interested in selling at these prices. They're thinking about where silver might be in 6 months or a year, not where it is today. Condition number 3, the paper market's ability to print its way out of problems is getting constrained by delivery stress. And this is the part that makes traditional commodity analysts extremely uncomfortable, because it challenges the fundamental assumption that futures markets always have enough liquidity, that the system always works, that there's always a way to settle contracts and keep the game going. Here's the reality that most people don't understand. If the COMEX, which is the big futures exchange in New York where most silver trading happens, has a massive amount of paper promises outstanding, hundreds of millions of ounces worth of contracts that theoretically could demand delivery, but a rapidly shrinking pool of registered physical metal that can actually be delivered against those contracts, the entire system becomes a timing problem. It's like musical chairs. As long as the music is playing and everyone's walking around the chairs, everything seems fine. But the moment the music stops and everyone tries to sit down at the same time, you realize there aren't enough chairs for everyone. Because the moment too many contract holders simultaneously demand physical delivery instead of just cash settlement, the exchange faces a choice between several ugly options, none of which end well. They can implement forced cash settlement, which means telling people, sorry, we know you wanted actual silver, but here's cash instead, which destroys confidence in the market. They can impose emergency rule changes like position limits or forced liquidation, which means telling big traders, you have too much exposure, you need to reduce your positions immediately, which creates panic. They can raise margin requirements, which means requiring traders to put up more cash as collateral, which forces speculators out of the market. They can implement trading halts, which means stopping all trading for hours or days, which terrifies everyone. All of these options send the same message to the market. Physical metal is tight, tighter than we've been admitting, and the paper price that you see on your screen is no longer reflecting physical reality. And when physical is tight, when the ratio of paper claims to actual deliverable metal gets uncomfortably high, the path of least resistance for price is straight up. Because every entity that needs real metal, not a cash-settled contract that gives them dollars instead of silver, but actual physical silver that they can touch and use, is going to bid aggressively, frantically even, to secure supply before it disappears entirely, and that aggressive bidding pushes price higher, which forces more short covering, which pushes price even higher. It's a feedback loop that can run completely out of control. Now, I'm not telling you this to make you panic. I'm not telling you this to create fear or anxiety or to make you do something stupid with your money. I'm telling you this because the God candle we saw on January 14th is exactly the kind of signal that appears right before the broader market realizes that the game has changed, that the old playbook doesn't work anymore. And to prove that this isn't just theory, to prove that this pattern actually predicts major moves and isn't just me making stuff up to sound smart, we need to look at history. Because history doesn't repeat exactly, but it does rhyme like a bad poet who keeps using the same words. Let me take you back to 1979 and 1980, which some of you will remember if your memory is better than mine. This is the last time silver entered true price discovery mode with a structural supply deficit. Silver didn't climb like a staircase in that period, nice and steady and predictable. It moved in 3 distinct phases, and understanding these phases is absolutely critical to understanding what might be coming next, assuming history decides to rhyme again. Phase 1 was the slow grind. From the low single digits, maybe $4 or $5, up into the teens, maybe $15 or $16, the move was messy. It was volatile, meaning it went up and down a lot without making consistent progress. It was boring for long stretches where nothing seemed to happen and people lost interest. Most people ignored it completely because it looked like random noise, like static on an old television. Nobody paid attention except the few people who understood what was building underneath the surface. Phase 2 was acceleration. Silver ran from the teens into the 20s and then the 30s, and suddenly everyone started paying attention. The financial media started covering it. Newspapers ran articles. Mainstream investors who had never thought about silver in their lives started asking their brokers about it. Friends started talking about it at dinner parties. The move had gained legitimacy. It was no longer just some obscure commodity that weird people collected. It was a story. It was news. Phase 3 was the vertical move. This is the phase that looks completely illegal when you see it on a chart decades later. This is the phase where price doubles in weeks instead of months or years, where it moves so fast that people think the data feed is broken, that surely there's been some kind of error, that this can't be right. In that era, the final parabolic burst was measured in days and weeks, not months. The part of the move that made people genuinely wealthy, that changed lives, happened so fast that if you weren't already positioned, if you hadn't bought before Phase 3 started, you had essentially no chance to get in at reasonable prices. By the time you figured out what was happening, it was already over. Now jump ahead to 2010 and 2011, which is more recent, and some of you probably remember this one if you were paying any attention to financial news. Same three-phase pattern. Different numbers, but same structure. There was a grind phase where silver moved from $12 to $20 over about 18 months. Slow, choppy, boring for long periods. Then there was an acceleration phase where it ran from $20 to $35 in a few months. People started noticing. Media started covering it. And then there was a vertical phase where it went from $35 to $49 in a matter of weeks. And what marked the transition from acceleration phase to vertical phase in both of these historical examples? A monster candle on monster volume with almost no rejection, a signal that the market had entered no reference points territory, a God candle. So when I look at the candle from January 14th, 2026, I don't just see a strong day. I don't just see silver having a good rally. I see a phase change. I see the market transitioning from phase 2, which is acceleration, into phase 3, which is vertical. And if I'm right, if this pattern holds the way it held in 1980 and again in 2011, the move we're about to witness in the next 30 days is going to be so extreme that people who aren't paying attention right now, people who are too busy with their daily lives to notice, will not believe it's real when they finally look at the charts. Now, I can already hear the skeptical voices in my head, and maybe you're one of them. William, a single big candle doesn't guarantee anything. The market could reverse tomorrow. This could be a bull trap where it looks like it's going up but then crashes back down and catches everyone who bought. You're reading too much into one day of trading. And you know what? You're absolutely right. A single candle in isolation, by itself with no other context, is not a prophecy. It's not a guarantee. It's not a crystal ball. Markets don't work that way. But a God candle combined with certain confirming signals creates what we call a high probability setup. It's not certain, but it's likely. So let me stack the evidence for you piece by piece, layer by layer, so you can see the full picture instead of just one corner of the puzzle. Let's start with something called the weekly RSI, which stands for Relative Strength Index. This is a mathematical indicator that measures whether a market is overbought or oversold on a scale from 0 to 100. Yes, it's currently screaming overbought. It's deep into the 80s, potentially touching 90. And that scares people who learn technical analysis from textbooks or from their broker's free seminar at the local library. Because textbooks teach you that when RSI gets above 70, you should be cautious. When it gets above 80, you should be looking to sell or at least take some profits because the market has rallied too much too fast and a pullback is coming. But here's what those textbooks don't emphasize enough, what they mention in a footnote that nobody reads. In commodity markets during discovery phases, overbought conditions can persist for weeks or even months. Overbought is not always a sell signal. Sometimes overbought is not a warning. Sometimes it's simply the signature of a market in runaway mode. Sometimes it's the fingerprint of a short squeeze, where people who bet against the market are forced to buy to close their positions, combined with genuine physical demand overwhelming available supply. If you sold every single time RSI hit 80 during the 2010 to 2011 silver rally, if you followed the textbook rule religiously like a good student, you would have been stopped out, forced out of your position in early 2011 around $35 and missed the entire move from 35 to 49. You would have left 40% of the gains on the table because you followed a rule that doesn't apply in discovery mode. If you sold every time RSI hit 80 during the 1979 to 1980 rally, you would have missed the vertical phase entirely. You would have sold at $20 and watched in agony as silver went to 50. Overbought in discovery mode is not a warning, it's confirmation. It's the market's way of telling you that this isn't normal behavior, that we're in a different regime now, that the old rules don't apply. So yes, RSI is overbought, and I'm telling you that doesn't mean what you think it means. Now let's talk about the physical market signals, because this is where the God candle story gets validated by real-world stress indicators that you can verify independently. First, something called lease rates. When the cost to borrow physical silver spikes dramatically, when entities have to pay high interest rates just to borrow silver temporarily, it's not manipulation. It's not some conspiracy. It's a genuine stress indicator. It's the market telling you that physical metal is scarce and entities that need to borrow it, maybe to cover a short position or fulfill a delivery obligation, are willing to pay premium rates. In mid-January 2026, lease rates surged to levels we haven't seen since the 2021 squeeze when Reddit briefly went crazy for silver. That kind of move doesn't happen randomly. It happens when someone somewhere needs physical metal urgently. The specifics don't matter as much as the signal, stress in the physical market. Second, physical premiums. If you've tried to buy silver coins or bars in the last week, and I hope you have, because if you haven't, you should seriously consider it, you already know that spot price is not the real all-in cost. The spot price you see on financial websites is just a reference number. When you actually go to buy physical silver, you pay spot plus a premium. Right now, premiums on American Silver Eagles are running $18 to $22 over spot. Premiums on Canadian Maple Leafs are $15 to $18 over spot. Even generic rounds, the cheapest form of physical silver you can buy, are commanding $8 to $12 premiums. When premiums stay elevated and wide like this for days or weeks, not just a temporary spike, it means one of two things is going to happen. Either physical supply suddenly floods the market and premiums collapse back to normal, or the paper spot price rises to close the gap with where physical has been trading. History shows us that in tight markets, it's almost always the latter. The paper price eventually catches up to where physical reality has been all along. Third, inventory stress. This is the big one that keeps me up at night, though, to be fair, many things keep me up at night at my age. When deliverable inventories at the COMEX shrink while the number of outstanding paper contracts remains huge or even grows, the mathematics become very uncomfortable. If there are 200 million ounces worth of paper claims outstanding but only 50 million ounces of registered physical metal available for delivery, the system depends entirely on most participants not asking for delivery at the same time. It's the musical chairs problem I mentioned earlier. That works fine until it doesn't. And God candles tend to appear right when the until it doesn't moment starts creeping closer. We are currently at one of the lowest registered inventory levels in COMEX history, while open interest, the total number of outstanding contracts, remains near all-time highs. That's not a sustainable situation. That's not a system in equilibrium. Something has to give. And when something gives in a commodity market with tight physical supply, when the stress finally releases, price goes vertical. Now, let me lay out a practical timeline for you, because saying $250 silver in 30 days sounds like complete fantasy, like something I made up while having too much coffee, unless you understand how discovery moves actually unfold in real-time trading. Think of this as a 3-act play, like a movie with a beginning, middle, and end, and we're currently somewhere between Act 1 and Act 2. Act 1 is digestion. After a candle like January 14th, after such an explosive move, the market often pauses, not because the bullish thesis died, not because the move is over and everyone should go home, but because the market needs time to absorb the shock, to process what just happened, to let participants adjust their positions and their psychology. Buyers who chase the God candle, who got excited and bought at $92, take some profits. They sell a portion to lock in gains. Shorts, the people betting against silver, regroup and attempt to cap price to prevent it from running higher. The chart chops between levels. Volatility remains extremely high, meaning price swings are large, but price generally holds above key support zones without breaking down. If silver spends several days consolidating in the $92 to $98 range without breaking down below 90, that's not weakness. That's actually strength. That's the market accepting higher pricing as the new normal. That's the new floor being established. And acceptance is fuel for the next leg higher. Right now, as I'm recording this on January 21st, we're in this digestion phase. Silver is holding the mid-90s. It's not collapsing back to 80. It's not giving back the God candle and admitting defeat. It's building energy for the next move like a runner catching their breath before the final sprint. Act 2 is the breakout. Once the market senses that dips aren't working, that attempts to push price lower keep failing, that sellers are scarce and every dip gets bought aggressively within hours, it makes the next push. A clean close above $100, which is a massive psychological level because humans love round numbers, becomes the ignition point. News headlines begin appearing. CNBC, which has ignored silver for months, suddenly runs segments about it. Bloomberg publishes analysis pieces. Reuters interviews mining executives asking them what they think about the rally. Financial commentators who completely ignored silver for the last 3 years, who couldn't tell you the difference between silver and aluminum, suddenly have strong opinions about it. Momentum-following funds, which are investment vehicles that buy things going up and sell things going down based on algorithms, receive buy signals from their computer systems. Systematic traders, who follow rules without emotion, get triggered to enter long positions. Stop losses get hit on the short side, meaning people who bet against silver have their protective sell orders activated, which forces them to buy to close their positions, which pushes price higher. And here's the key. Every short that covers is a buy order. It doesn't matter if they're buying reluctantly or enthusiastically, they're buying. And buying pushes price up. This is where FOMO, fear of missing out, starts to enter the market in a meaningful way. People see the headlines and think, maybe I should own some silver before it gets more expensive. Act 3 is the squeeze in the air pocket. This is where people absolutely lose their minds because price stops moving in rational increments. The chart doesn't offer nice entry points. It doesn't pull back to convenient support levels where you can buy comfortably. It gaps overnight, which means it opens significantly higher than it closed without trading at prices in between. It runs 8% in a single session, pauses for a day while everyone catches their breath, then gaps another 10% the next morning. If you're trying to buy, you're constantly chasing. If you're watching from the sidelines, you're in disbelief. If the market enters a zone with extremely low prior volume acceptance, what technical analysts call an air pocket on the volume profile, which basically means a price range where very little trading occurred historically, it can travel ridiculously far before it finds genuine resistance, because there's simply not much supply offering at those prices. Nobody owns silver with a cost basis at $180 because it's never been there before. Nobody has sell orders sitting at $200 because why would they? So when price enters that territory, when it pushes into the 170s or 180s or higher, it's basically shooting through vacuum. There's nothing to slow it down. And this is where the 30-day timeline comes from. In past silver vertical moves, both in 1980 and in 2011, the steepest part of the rally, the part that generated 80% of the total gains, happened in the final 20 to 30 days. Not 6 months. Not a year of steady climbing. 3 to 4 weeks of absolute insanity. That's how fast discovery mode can move when physical scarcity meets paper market stress, meets FOMO, meets short covering all at the same time. Now imagine taking that historical pattern, but overlay it with today's conditions, which are arguably worse or better depending on your position. We have a deeper structural deficit than 2011. We have broader industrial demand from solar panels, electric vehicles, and 5G networks that didn't exist or barely existed back then. We have geopolitical competition for Arctic resources with the US and China bidding against each other for Greenland. We have central banks around the world printing currency at unprecedented rates, which devalues paper money and makes hard assets more attractive. We have gold approaching $5,000, which means the entire precious metals complex is in a raging bull market. The setup today is even more explosive than the historical precedents. Here's the part that's going to mess with your head, and I need you to be prepared for it psychologically, because psychology is 90% of success in markets. The market will try to bait you with normal thinking, right? When conditions stop being normal. You'll see a $5 pullback, and 20 analysts will immediately declare that the move is over, that silver has topped, that it's time to sell. You'll see one red day after 5 green days, and the financial media will publish articles with titles like "Silver Rally Loses Steam," or "Is the Silver Bubble Already Popping?" Then, 48 hours later, silver will rip $15 higher overnight, and those same voices will pretend they saw it coming all along. This is the psychological warfare that happens in parabolic markets. The crowd is always looking in the rearview mirror, trying to apply historical norms to a market that has left history behind. They're fighting the last war, while the current war has different rules. So I want you to watch one specific thing over the next few trading sessions, and this will tell you more than any fancy indicator or complex mathematical formula. Watch how price behaves on pullbacks. Does it dip on low volume and rebound quickly within hours, or does it dump on heavy volume and struggle to recover for days? That single difference tells you whether the big money, the smart money, the institutional players with billions of dollars are quietly accumulating on weakness, which means buying when price dips, or whether the move is actually failing and the momentum is broken. If every dip is bought immediately on low volume, if price snaps back within hours like a rubber band, that's accumulation. That's strength disguised as weakness. That's confirmation that the bid, the willingness to buy, is real and deep. But if dips happen on massive volume with price struggling to recover, that's distribution, that's smart money selling to dumb money. That's the beginning of the end. This is William Lee, and we are potentially living through one of the defining commodity moves of our generation. The God candle was the signal. Everything that's happened since has been confirmation. And what happens in the next 30 days will determine whether you look back on this moment with satisfaction or with regret. The choice, as always, is yours. But don't say nobody warned you, because I just did. Pay attention, stay sharp, and whatever you do, don't let fear or greed make your decisions for you. This is history happening in real time. Welcome to the vertical phase.